Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: What are economic indicators? Economic indicators are essential tools used by economists, policymakers, and analysts to assess the health of an economy. These indicators provide quantitative data that offer insights into various aspects of economic performance, such as growth, inflation, employment, and trade. Understanding economic indicators is crucial for making informed decisions in both public and private sectors. Gross domestic product is one of the most widely recognized economic indicators. It measures the total value of all goods and services produced within a country over a specific period, usually a year or a quarter. GDP can be calculated using three approaches: the production approach, which sums the value added at each stage of production; the income approach, which sums all incomes earned by factors of production; and the expenditure approach, which sums all expenditures made for final goods and services. For instance, the United States had a nominal GDP of approximately $21.43 trillion in 2019, making it the world's largest economy. GDP growth rates are used to gauge the economic performance of a country over time. Positive GDP growth indicates economic expansion, while negative growth signifies a contraction. Inflation is another critical economic indicator, reflecting the rate at which the general level of prices for goods and services is rising, and subsequently how purchasing power is eroding. The Consumer Price Index and the Producer Price Index are primary measures of inflation. The CPI measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. For example, the U.S. CPI increased by 2.3% in 2019. The PPI measures the average change over time in the selling prices received by domestic producers for their output. Monitoring inflation is vital as it influences interest rates, wages, and the cost of living. Unemployment rates provide insights into the labor market's health and are calculated as the percentage of the labor force that is jobless and actively seeking employment. High unemployment rates indicate economic distress, while low rates suggest a robust job market. The U.S. unemployment rate was 3.5% in December 2019, the lowest in 50 years, reflecting a strong labor market. However, these rates do not capture underemployment or discouraged workers who have stopped looking for jobs. Therefore, additional metrics like the labor force participation rate and the U6 unemployment rate, which includes part-time workers seeking full-time employment, are also important. Trade indicators, such as the balance of trade, export and import levels, and trade deficits or surpluses, provide information about a country's economic interactions with the rest of the world. The balance of trade is the difference between the value of a country's exports and imports. A trade surplus occurs when exports exceed imports, while a trade deficit occurs when imports surpass exports. For instance, the U.S. had a trade deficit of $576.9 billion in 2019. Trade indicators can affect currency exchange rates and influence economic policies. Interest rates, set by a country's central bank, are another crucial indicator as they influence borrowing costs, consumer spending, and investment. Central banks, such as the Federal Reserve in the United States, use interest rates to control monetary policy and stabilize the economy. Lower interest rates typically stimulate economic activity by making borrowing cheaper, while higher rates aim to curb inflation by making borrowing more expensive. For example, in response to the 2008 financial crisis, the Federal Reserve reduced the federal funds rate to near zero to boost economic growth. Consumer confidence indexes, such as the Consumer Confidence Index and the Michigan Consumer Sentiment Index, gauge the optimism of consumers regarding their financial situation and the overall economy. High consumer confidence usually leads to increased consumer spending, which drives economic growth, while low confidence can result in reduced spending and slower economic growth. In December 2019, the US CCI was 126.5, indicating relatively high consumer confidence. Business confidence and investment levels are also significant indicators. Business confidence surveys, such as the Purchasing Managers Index, measure the optimism of business managers about future economic conditions. A PMI above 50 indicates expansion, while below 50 suggests contraction. For example, the U.S. manufacturing PMI was 47.2 in December 2019, indicating a contraction in the manufacturing sector. Investment levels, including capital expenditures by businesses, reflect the willingness of companies to expand operations and invest in new projects. Leading, lagging, and coincident indicators help predict future economic activity. Leading indicators, such as stock market returns, new orders for capital goods, and building permits, provide early signals of economic changes. Lagging indicators, such as unemployment rates and corporate profits, confirm trends after they have been established. Coincident indicators, such as industrial production and retail sales, move in tandem with the overall economy. For example, the Conference Board's leading economic index for the U.S. increased by 0.8% in January 2020, suggesting economic growth in the near term. Economic indicators are not without limitations. They are subject to revisions and can be influenced by short-term fluctuations and external shocks. Additionally, no single indicator provides a comprehensive view of an economy's health. Therefore, a combination of indicators should be analyzed to obtain a more accurate assessment. Policymakers, investors, and businesses use these indicators to formulate strategies, make investment decisions, and implement policies that promote economic stability and growth. In conclusion, economic indicators are vital tools for understanding the health of an economy. They provide valuable insights into various economic aspects, including growth, inflation, employment, trade, and consumer and business confidence. By analyzing these indicators, stakeholders can make informed decisions that contribute to economic stability and growth. The interplay of different indicators offers a comprehensive picture of economic conditions, aiding in the formulation of effective economic policies and strategies. Understanding and interpreting economic indicators is essential for navigating the complexities of the global economy and making sound economic decisions. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.